Central banks play a crucial role in governing the banking industry by implementing policies and regulations that ensure financial stability, economic growth, and consumer protection. They function as the primary regulatory bodies overseeing commercial banks and other financial institutions. Below are some key ways in which central banks govern the banking industry. 1. Monetary policy implementation. Central banks control the money supply and interest rates to influence economic conditions. By adjusting interest rates, they regulate borrowing and lending, which affects inflation, employment, and economic growth. They use tools like open market operations (OMO), buying and selling government securities to regulate liquidity in the banking system, discount rate, adjusting the interest rate at which banks borrow money from the central bank, reserve requirements, setting minimum reserves that banks must hold to ensure financial stability. 2. Regulating commercial banks. Central banks establish guidelines and rules for commercial banks to maintain a healthy financial system. These regulations include capital adequacy requirements. Banks must hold a minimum level of capital relative to their risk-weighted assets. Liquidity requirements, ensuring that banks maintain enough liquid assets to meet short-term obligations. Loan restrictions, setting limits on risky loans to prevent excessive lending. 3. Supervision and risk management. Central banks monitor and assess the financial health of banks through inspections, audits, and stress tests. These evaluations help identify potential risks before they become systemic issues. They also enforce compliance with financial regulations to prevent fraud, money laundering, and unethical banking practices. 4. Issuing currency. Central banks have the exclusive authority to issue currency, ensuring the stability and integrity of the national currency. By controlling the money supply, they prevent inflation or deflation, both of which can impact the economy negatively. 5. Lender of last resort. In times of financial crises or liquidity shortages, central banks provide emergency funding to prevent bank failures and systemic collapse. This role helps maintain public confidence in the banking system and prevents widespread economic disruptions. 6. Foreign exchange and financial stability. Central banks manage foreign exchange reserves and intervene in currency markets to stabilize the national economy. They may set exchange rate policies, manage inflation, and control foreign capital flows to ensure economic balance. 7. Consumer protection and financial inclusion. Central banks also establish consumer protection laws and ensure fair banking practices. They regulate interest rates on loans and deposits, prevent discriminatory practices, and promote financial literacy to enhance access to banking services.